Hello and happy Thursday. Welcome to our Lunch and Learn Thursdays. I think this is our first one of 2023, so we're so excited to be here. For those of you who are new to Purse Strings, we are all about providing financial tips, tricks, pieces of advice for women. And then when it goes time to, get a financial planner, get a will, get divorced, get married, need any of these big transitions or transactions, we have top tier financial professionals willing, ready, and able to serve you. We call those our Purse Strings approved professionals, and Lyndsey Monahan is one of them. And so we're so excited to have her on today to dive into this month of this year. I'm going to, and kind of fill in that blank of different goals and things like that. And so today we're going to talking about, this year I'm going to kind of recover from that holiday spending, get out of debt, and set some goals. So before we dive into all of that fun, Lyndsey, could you give us a little intro of who you are and what you do?
You bet. Hello and happy new year to everybody. How about that? This is
Yeah.
exciting. This is my first live of the year, so I'm excited about that too. So Lyndsey Monahan, and my company is called Women Inspire Wealth. And what I do is I focus on helping women and their families create a financial plan and strategy for the future. And there's a lot of education involved in that. There's also just a lot of teaching strategies and deciding what works best for women and their families moving forward. So that's pretty much what I do. I'm a financial consultant and a financial planner.
Awesome. Well, we're excited to have you on today
Thank you.
and to talk about all these great things. And I love, even when we were talking about this, how you're like, oh, I want a holiday hangover spending twist,
Yes.
because I think a lot of us feel that kind of now that the holidays are done. As much as we try to stick to our budget and things like that, there's always things we forget. So yeah, let's dive in. How do you kind of define this holiday hangover spending?
So the holiday hangover for me is really just that feeling that you have after the holidays, right? And so usually that week between Christmas and New Year's, you probably have some things that you're still parties you're attending, family gatherings you're still doing. And like the first week of January, you're finally like, I can breathe, right? And I'm done with all the holiday spending. And so now you're starting to get those bills in the mail, right? Especially if you used your credit card at all during the holidays, which I know we all start off saying, oh, we're not going to do that. Or maybe you're that person that you always put everything on your credit card and then you just pay it off every month, right? Like there's definitely different strategies about spending. So the holiday hangover is just something for me that always represents that feeling after the holidays, kind of how you put yourself and your family back into the regular, I don't know, day to day that we go
Yeah.
through and getting your finances back on track as a result of that. So that's how I define it.
Definitely. I mean, it's getting back into the routine. I mean, even getting back maybe to your own bed if you've been traveling. But yeah,
Yes.
it's getting back to that normal spending, more of the status quo. And so I think sometimes people now can find themselves that they, maybe went into some debt during the holidays and we're trying to figure out how to get out of that. And so do you have some tips on how to kind of like start approaching this as we, want to get off the new year on a good foot?
Yeah, so I always say you need to kind of take a step back before you start tackling that debt, right? So the very first part of that is what are your goals for the year, right? And so really kind of setting those goals up and saying, my goal is to be debt free by such and such date, right? Or really come up with what I call, or what's commonly referred to as a SMART goal, right? So you want something that's specific, measurable, achievable, right? Like needs to follow all of those things a part of a SMART goal. So maybe your goal is to get your debt paid off in the first month, 2, 3 of the year, or maybe it really is I want to get it paid off before next holiday season. Whatever that is, you have to know what the goal is first, right? And make it achievable. Then the next step in that is really saying, what am I trying to accomplish by paying off this debt? Because I think there's a couple of different ways that you can approach it, right? Like you can say, oh, I'm going to debt snowball this, which means I'm going to pay off the highest interest rate card first, and I'm not going to look twice at anything else until I actually get there. Excuse me, I got a little bit of sunshine coming
Feel that coming through too. Yeah.
through. But understanding how you want to attack the debt is the next step, right? So maybe you're trying to boost your credit score, or maybe you're trying to accomplish a different goal with it. There's different ways to attack your debt based off what your goal is. And so really kind of thinking through what am I trying to accomplish here? And then building out a plan for it.
I love that. I love that. And it is important to kind of see, what the goal is, because sometimes debt free is just, it's not always a drive enough, or it's not like I don't know. It's not as satisfying as it might sound, and it's just like, well, how do I drive myself to really get there? And so it might be, a different goal past that that's really what you're trying to achieve.
Right. So, like a common one that I have with some of my clients right now is they're saving to buy a home, right? And so
Mhm.
their goal really is to boost their credit score, but then it's also pay down some of that thing. So, how can you do those things together? And it's entirely possible with the right debt management or debt attack plan.
Definitely. And so I know there's the debt snowball and the debt avalanche. Are those usually the two that you talk about?
Yep, debt avalanche, debt snowball. Then there's also some out there where you can actually say, no, I want to go about this in a credit worthiness or a credit score approach too. And so I don't know what if there's a formal name for it, but there's a rhyme and a reason as to why you would use a credit approach to something rather than, just the jet snowball or the jet avalanche, right? And just so we kind of talk through what those different things are. The jet avalanche is more taking the card that has the highest balance and paying it off first, whereas the debt snowball is more about the interest rate. So with the credit score, it's saying which one of these cards is impacting my credit score in the most
Mhm.
positive or negative way and approaching it that way. So
Interesting. Yeah, that one I have not heard about before. So it's interesting to learn about that
yeah,
because you hear a lot about the snowball and the avalanche versus the debt and the interest rate, but it makes a lot of sense to kind of work on what's affecting your credit score the most, especially if you're trying to do something like purchase a home.
yeah, absolutely.
Um, and so, are there other goals that you recommend setting at the top of the year for your finances to kind of help you get started for the rest of the year?
Oh, yeah, absolutely. So, especially if you're a business owner, making sure that you're really clear on what are the goals and objectives of my business and how's that going to impact my cash flow personally? Because
Mm.
everything ultimately is going to come back to what are you personally trying to do? And then how do you use your business or, your career to impact what you're trying to do personally, right? So,
That's a great tip. Yeah, because it does matter. Your business is you. As much as you try to separate them, they are one and the same. So they do really play to each other hand in hand.
exactly, exactly.
Awesome. Somebody was saying, how do you know which debt is affecting your credit score?
So you definitely have to have your credit report to know that, right? But then you
Okay.
can also look at the credit utilization of your card, right? So let's say that you have a card where the credit limit is $5,000 and your card is at a, I don't know, call it a $4,800 account balance, right? But then you might have another card that has a $10,000 balance or a $10,000 credit limit and the balance is only $2,000. If the interest rate's higher on the $10,000 card, but it's lower on the $5,000 card, the $5,000 card is probably impacting your credit more right now than the
Mhm.
other one, even though the interest rate's higher on the other one.
That makes sense because it's about the utilization.
Yes, exactly. It has to do with the utilization.
Great question. Thanks for asking that and clarifying that one for
Yeah,
sure.
absolutely. Absolutely. There's other things too that I think kind of go into that too. And just knowing where you are credit wise makes a big difference too. So if you haven't pulled your credit report recently, having a copy of your credit report, that's going to tell you a lot that you need to know about paying down debt, especially after the holidays. Just kind of get a grip on where you're at and knowing when and where your payments are due and not missing payments, all that kind of good stuff too.
Definitely. We always recommend like automations or things like that just to make sure it's all paid on time. But I know you can easily check some of those things just on your bank app or things like that. You don't always need to do that full pull from like a credit bureau.
Exactly, exactly. So like for instance, we both, my husband and I have separate banking institutions. I use Chase as a big bank, and he uses Bank of America as a bigger bank. And both of them have the ability to go out just by accessing our apps on our phone to say what the last credit reading is that they have. And that's not a hard pull on your credit, that's a soft pull. I would definitely not advise doing a hard pull on your credit unless you're in like the big purchase shopping time right now.
Mhm.
Does that make sense?
Definitely, definitely.
Perfect.
Yeah, and so um, I know, yeah, it's hard to get caught up and then start hitting your goals for the next year. It's just
Yeah.
crazy.
I think this is a good time of year also to take a look at like some of the things that we maybe have subscriptions for that
Yeah.
we take for granted. And, you know, I've had gifts in the past where I was gifted a subscription to something, right?
Okay.
So, one that I can think of is like I had been gifted a bacon subscription once in the past. Like, I know
I've
it sounds
seen those.
crazy.
Yep.
It sounds crazy, but like if that is something that you've been gifted in the past, more than likely you went in and you said, "Oh, I'm going to switch this over to my name," or something like that. If you're not looking to continue that subscription moving forward, making sure that you're going in and you're canceling that. January is a really great time of year to do that. That way if it's going to impact you this year, it's going to hit you in January and that's it. And it's not going to drag on for a couple of months. So just kind of doing that once over review of, is it Netflix, Hulu, is it the um I did bump in a box when I was pregnant, right? So so you can kind of see like what maternity things were out there, or I know there's like of the bark box and things like that
Yep.
for pets, right? Like taking a look at every one of those subscriptions and saying, is this something that's adding value to my life? Is it something I want to continue, or is it something that I want to let go? And making those decisions now, so it's only impacting you right now.
I love that. And yeah, it's like you can try it out too and see, how many bark boxes do you need? Maybe
Right.
in 6 months you can start it again once your dog chewed through all the toys. But take a 6 month hiatus from whatever that is, as well. Especially some of those that are on the annual renewal, and all of a sudden you get that lump sum payment, and you're like, I really didn't
I
need
wasn't
that.
expecting that.
But do I want to go and like not fight with them, but just go back and forth on canceling this and getting that refund? Sometimes you're like, that's a lot of work as well.
Yeah, I think you mentioned that too about annually paying something versus monthly paying something. This is another great time of year just to kind of do a refresh on those things too. Are there bills that you can lower, and I'm putting air quotes in lower, or you get a discount on for paying annually? And do you have the ability or the capacity to do that right now? Again, January is a good time to just kind of sit down and say, overall, with personal finances, are there things that I can eliminate, reduce costs on, things like that?
Definitely. Yeah, it's a great time to do that. Somebody else commented apps on your phone. Great time to just cancel some of those because they're easy to run away from us, whether we tried to meditate for a while or do some yoga or, do some different things on there. They're easy just to get away from us.
Yeah, and I will tell you, when I sit down and I do financial planning with my clients, one of the first things we do is we do cash flow analysis and a spending plan, right?
Yep.
And this is always a category where we sit down and we say, okay, let's look at those subscriptions and are we using them? Are we not using them? Do you realize how much you're spending on those every month? And if you had a chance to take a step back and look at those, which ones do we really want to move forward with and which ones are we going to stop? So,
Right. Yeah, I even saw this one tip that was like, you don't watch for streaming services at once. Just pay for one a month and then maybe every 3 months change it out because then you can catch up on those different shows instead of paying, $50 for all the
exactly.
streaming services every month.
Exactly, exactly, and I know we use Netflix, we pay annually with Netflix, and it reduces the overall monthly cost. It's pretty
Right, right.
significant to do that, so.
What other so you start usually when you work with your clients to go over kind of a spending plan and what they're
Yeah.
spending and things like that. Is there anything else that you kind of always do at the beginning when diving into finances and taking that fresh look?
Yeah, I would say the first thing, and I'll just talk about what my husband and I do from a financial planning perspective every January too. Like we always sit down and the first couple days of the year, well, we're still not working, right? We're observing the holiday. One of the things we do is we go through our budget. So the things I'm telling you to do, we do the exact same thing in our household. Go through and say, okay, what are the bills? How do we get everything updated? What are the cash flow that's coming in? Where's it coming from? And just having an overall understanding of it. We also take that time to update our balance sheet or our net worth statement. So we can say, okay, here's all of our assets, here's all the debts that we've had in the past, and here's how they've increased or decreased throughout the year, and here's our net worth. So it's just a good time to kind of get a handle on where you are financially so that you know going into the year. And maybe your goal at the end of this year is I want to increase my net worth by X, Y, and Z number,
Mhm.
rather than it being so focused on, oh, I'm trying to generate X, Y, and Z more income.
Right. I love that. And that's a great I mean, first of all, we always hound that like you should do this with your partner. Have these open conversations with your partner and have this big kind of conversation probably annually. I'm sure you guys talk at least like monthly or every couple of weeks
Or
about
every
where
day.
you're yeah, about where you're at. And it's just it doesn't become this heavy conversation, but it's just like you're both then knowing that you're aligning with the same goals, you have
Yes.
the same vision for the year, which is really important, and to start on that same page.
Yes, absolutely. And like your net worth is not one of those things that you need to look at on a monthly basis even.
Right.
Like we might look at our net worth twice a year now, right? We know conceptually where it's at any given point. We can probably throw an estimate out and be within a few $1,000s of where it is, but it's just one of those things that it's nice to have the number top of mind rolling into the year, and then talking about as a couple for us where we want to be, or if it's just you as an individual, where do I want to be at the end of the year?
Hmm. Definitely, definitely. And then do you two work together to set goals around that?
We do. We absolutely do. So this year we have a really big net worth goal because we're looking to acquire a property that's going to
Awesome.
add, property value to our net worth, but it's also going to increase cash flow in our passive income bucket. So
Yeah,
we know what those goals are together, and that helps us stay grounded together.
I love that. I love that. That's a great way to just start the year on the right foot together. And see from that holiday spending and all of that, we kind of get lost at the end of the year of, what's kind of happening and lose some of our goals at the end. So it's just kind of pulling it back together and really kind of, yeah,
Yeah, and
setting our
kind of getting
goals.
organized too. Like this is the time of year where you're going to start getting all of your tax documents from last year as
Yep.
well too. So between now and the end of January, you're going to start getting a lot of tax statements in the mail. And so understanding where you ended the year, where you're rolling into this year, and then getting organized with your personal finances, which I'm going to laugh when I say this, but I hate calling it a budget. Like we don't call it a budget in our household. We call it a monthly wealth plan because
Okay.
that tool helps us build our wealth, right?
Right.
And so we know where we are with our monthly wealth plan, and we understand how that's changed from last year to this year by taking the time to get organized at the beginning of the year.
I love that monthly wealth plan. I know there's always a different name, so I always love to see what people have. I've heard, spending plan, wealth plan, not the B word. So we won't call it
Keyword.
that. Um, yeah, it's a great way just to get in line.
Mhm.
Um,
Absolutely.
Kind of circling back, somebody asked, what's the difference between a soft and hard pull on credit? Could you answer that?
Yeah, really great question. So a soft pull is it's not even a pull really. Like it's somebody has a pulse on what's happening with your credit report. So like your bank is probably the best example of that. So inside a banking app where they're monitoring your credit or even a credit monitoring service, those are not considered hard pulls on your credit. Those are soft inquiries. They're looking for, how much is your credit score changing month to month. A hard pull on your credit is something that you use when you're, say, shopping for a car, you're shopping for a house, maybe you're looking for a line of credit somewhere. That is an actual credit inquiry that's saying, I want to understand where this person is right now from a debt to income ratio, how their payment history is working, all that kind of stuff. Whereas the soft inquiry it's just a pulse on where your credit is. That's how I like to explain that.
And so, how do those affect your credit score differently?
So not a credit expert, but I will say this,
Right.
hard credit inquiry, you only want to do those when you're shopping for big purchases typically, because too many of them together will result in negative activity on your credit report, right? Whereas a soft inquiry, I to my knowledge, I don't believe that that really impacts your credit all that much because
Right.
it's a consistent monitoring tool that's out there.
Awesome. Yeah. And so, yeah, you only want to do those hard pulls when it's like buying a house, buying a car, doing those big things where they need to do that for their purposes as
Yeah.
well.
And I will add it, I want to add this in here too, since we talked about that. When a hard inquiry is done that's associated with a big purchase, you typically have 30 days to do another credit pull or a hard credit inquiry for that purchase before it starts to negatively impact you. So just know that as well too, that those typically a credit pull like that lasts 30 days and it's considered part of the buying process as long as you're within that 30-day window.
Awesome. That's a great piece of tip to know, a piece of advice to know. Let me see if there's any other questions going in, but I already feel like this is a lot of great information just to start off the new year, to kind of get fresh, get started in January and, set some of those goals, whatever they be, buying a house, maybe just improving your net worth, improving your credit score, some of these bigger goals that really can really pay off in the long run. Are there any tips or tricks that we didn't cover today that you want to make sure is shared?
I think just one that I'll share around your around credit things, just because I know we were trying to talk more about debt management and that holiday hangover thing. I want to go back to understanding the long-term financial impact of using a credit card and what that actually
Mhm.
means. So the rule of 72 is a really great tool that you can use to understand interest rates with credit cards. Okay. So the rule of 72 goes like this: you take the number 72 and you divide it by the interest rate that they're charging you. Okay. And that number that you come up with is how long it's going to take them to double their money using your money. And it works the opposite way when you're trying to save or invest for yourself. The rule of 72, you take 72 divided by the interest rate that you're going to be earning, and that's how long it's going to take you to double your money. Okay. So let's talk about this a little bit more in detail. I bank with Chase. I said that earlier. I think Chase savings rate right now is super terrible. I don't use a savings account there, but it's like 0.01%, right?
Right.
So when you take 72 divided by 0.01, it comes up to 7,200 years for me to double my money in that account. Hence why I don't use my savings
Right.
account, right? But a credit card, for instance, let's say that you're using a credit card that's charging you 17% interest, right? 72 divided by 17, it's taking them less than 4 years to double their money or to double
Wow.
their money, right? So that's the difference between your earning power versus what you're spending using a credit card. And I know that there's all kinds of points programs and things out there that would justify you using your credit card and then paying it off, that type of thing. But
Right.
I'm talking about a running balance that's compounding all the time. That's where you start to get into the danger zone with credit cards.
You can see how that 72, the rule of 72 can either be really great
Or
or
really,
really bad, depending on which side you're on there. But it's interesting because, I was looking at like my credit card statement, and it's one of those things where they're like, if you pay the minimum balance, every month, it could take X amount of years to pay off or whatever it is. And
right.
you're just like, okay, so that would definitely be over double of what I even spent.
Yes.
Um,
And then asking yourself, is that item worth
Yeah,
whatever?
I didn't have $5 to start to buy it, but if I
Right.
had $10, would I still buy that? And probably not.
Right.
And so yeah, that's a great piece of math just to kind of have in your head and or do on your phone quickly to
Yes.
see how that's going to lay out. Awesome. Well, I don't think there's any other questions coming in. But my last question I always like to ask is like, if people start working with you, what does that process kind of look like to get started?
Yeah, so the very first thing that I do with somebody that's wanting to sit down and work with me is I have them book a call with me. It's a free consultation. There's no charge to sit down and talk to me about it. But we really dig into the why of like, what are you looking to do with your finances? What's driving you to want to make this change? And then let's talk about some of your goals so we can understand where you are today and where you want to be in the future. And so that initial call is about 45 minutes long, and it's done over Zoom, and then we move forward.
Awesome. Awesome. Well, if anyone is looking to reach out to Lyndsey, her email is on the bottom here. I'm also going to put her Facebook group in the chat on this group, so you can join her Facebook group as well. She's also one of our Purse Strings approved professionals, so you can check her out on our site, pursestrings.co. And yeah, book that call. Just have these conversations, make sure it's a good fit for you, set some of these goals, and let's make it the year of financial freedom.
That's right.
Um, so thank you again, Lyndsey, for coming on today and providing your expertise. And
Absolutely.
we
Thanks
will
for having
talk
me.
to everyone again next week.
All right. Thanks, Maggie.
All right. Bye bye.